In the shadow of global financial markets, where gold captures headlines and Bitcoin dominates conversations, silver has quietly transformed from a precious metal into a geopolitical weapon. What happened in the silver market between 2022 and 2024 wasn't just a price fluctuation or a supply chain disruption. It was a calculated dismantling of the Western-dominated commodity system, orchestrated by two nations with a singular objective: to reshape the architecture of global trade and monetary power. China and Russia, operating through state-controlled entities and strategic partnerships, have executed a multi-year campaign that has fundamentally altered the supply, demand, and pricing mechanisms of silver. The implications extend far beyond metal markets. They reach into the heart of the energy transition, defense manufacturing, and the very foundation of financial sovereignty. For decades, silver occupied a peculiar position in global commerce. Unlike gold, which serves primarily as a store of value and monetary reserve, silver straddles two worlds: industrial necessity and monetary metal. Approximately 60% of annual silver demand comes from industrial applications: solar panels, electronics, electric vehicles, water purification systems, and advanced military technology. The remaining 40% flows into investment products, jewelry, and silverware. This dual nature creates a unique vulnerability. Silver cannot be easily substituted in most industrial processes due to its superior conductivity and reflectivity properties. Yet its relatively small market size, roughly $90 billion annually compared to gold's $12 trillion market, makes it susceptible to strategic accumulation by large state actors. The foundation for the current crisis was laid long before the events of recent years. Throughout the 2010s, as Western nations pursued monetary expansion through quantitative easing and historically low interest rates, precious metals were increasingly viewed through a financial lens rather than an industrial one. Silver mining investment declined sharply as prices remained suppressed, with major discoveries dropping by over 70% compared to previous decades. Primary silver mines, those where silver is the main product rather than a byproduct of copper, lead, or zinc extraction, became economically marginal. Production costs rose steadily due to declining ore grades, environmental regulations, and energy expenses, while market prices failed to keep pace. By 2020, the global silver mining industry was operating on thin margins, with many producers barely breaking even. This created the perfect conditions for what would follow. China's strategic pivot towards silver began not in financial markets, but in industrial policy. The nation's commitment to dominating renewable energy manufacturing, particularly solar panel production, created unprecedented demand for silver. Each solar panel requires approximately 20 grams of silver paste for its photovoltaic cells, a quantity that sounds modest until multiplied across billions of panels. As China captured over 80% of global solar manufacturing capacity, it simultaneously became the world's largest consumer of silver for industrial purposes. But consumption alone doesn't explain what happened next. Beginning in 2020, Chinese state-owned enterprises and quasi-governmental entities began accumulating physical silver through spot market purchases, futures contracts, and direct mining investments across Latin America, Africa, and Central Asia. These weren't speculative trades. They were systematic acquisitions designed to secure supply chains and create strategic reserves. Russia's entry into the silver equation followed a different trajectory, but converged toward the same strategic endpoint. Following waves of Western sanctions that began in 2014 and intensified dramatically after 2022, Russia faced an existential challenge to its financial system. Cut off from SWIFT, frozen out of dollar and euro reserves, and blocked from accessing Western capital markets, Russia needed alternatives to the dollar-dominated system. While gold served as Russia's primary monetary reserve and sanctions hedge, silver offered something different, a critical industrial metal that the West desperately needed but couldn't easily replace. Russia possessed significant silver production capacity, primarily as a byproduct of its massive base metal mining operations and strategic relationships with other major producers. By controlling supply and coordinating with China, Russia gained leverage not just in commodity markets, but in the broader geopolitical competition with Western powers. The mechanics of how these two nations broke the silver market reveals a sophisticated understanding of commodity market structure. Unlike oil or wheat, which trade in massive daily volumes with deep liquidity, physical silver markets are relatively small and fragmented. The paper silver market, futures contracts, ETFs, and derivatives, dwarfs physical supply by a ratio estimated between 100 to 1 and 500 to 1, meaning that for every ounce of physical silver, there are hundreds of ounces of paper claims. This structure works smoothly when participants trust that paper claims can be converted to physical metal upon demand. But when large actors begin demanding physical delivery rather than cash settlement, the system faces stress. Between 2022 and 2024, Chinese and Russian entities systematically stood for delivery on futures contracts, withdrew metal from London and New York vaults, and purchased physical silver in spot markets.
Each transaction removed actual metal from the system while leaving paper claims intact.
The structural breakdown of the silver market didn't occur in isolation. It was accelerated by a perfect storm of geopolitical tensions, technological transitions, and financial system vulnerabilities that converged between 2022 and 2024. To understand the magnitude of what transpired, one must examine the specific mechanisms through which physical metal disappeared from Western vaults while paper claims multiplied, creating a pyramid of obligations that could never be simultaneously fulfilled. This wasn't merely a supply shortage in the traditional sense. It was a deliberate extraction of physical assets from a system built on the assumption that most participants would never demand actual delivery. The London Bullion Market Association, which operates the world's primary over-the-counter precious metals market, maintains a system of allocated and unallocated accounts. Allocated accounts represent specific identified bars stored on behalf of owners. Essentially, your silver sits in a vault with your name on it. Unallocated accounts, by contrast, represent claims against a pool of metal held by the custodian, similar to how banks operate with deposits. This system functions efficiently when redemption requests remain modest and predictable. However, starting in late 2022, redemption patterns changed dramatically. Large institutional withdrawals, primarily linked to Asian entities, began draining allocated silver from London vaults at unprecedented rates. Over 18 months, reported holdings in London dropped by approximately 30%. Roughly 10,000 metric tons disappeared from the system. Simultaneously, similar drawdowns occurred in New York's COMEX vaults, where registered silver available for delivery fell to multi-decade lows. These physical withdrawals created cascading effects throughout the derivative markets. Silver futures and options contracts trade on the assumption of cash settlement for most participants, with only a small percentage ever standing for delivery. But when delivery demands spike, the entire mathematical foundation shifts. Bullion banks and market makers who had sold futures contracts expecting cash settlement suddenly faced demands for physical metal they didn't possess. This forced them into the spot market to acquire silver at any price, driving premiums higher and creating feedback loops. As prices spiked, more speculators entered, betting on continued increases, which generated additional paper supply through short selling by banks attempting to cap prices. The gap between paper promises and physical reality widened into a chasm. China's role extended beyond simple accumulation. It restructured global supply chains to ensure dominance over silver's most critical applications. The country's control over solar manufacturing meant it could dictate terms to global silver suppliers, effectively creating a bifurcated market, one price for Chinese industrial users with guaranteed supply, and another for everyone else facing scarcity. This wasn't accidental. Chinese industrial policy explicitly targets commodities where leverage can be achieved through vertical integration. By 2024, Chinese entities controlled approximately 40% of global primary silver mining production through direct ownership or strategic partnerships, up from less than 15% a decade earlier. These acquisitions focused on Latin America, particularly Mexico, Peru, and Bolivia, where regulatory environments allowed foreign investment in exchange for infrastructure development and employment. The silver extracted from these mines increasingly flowed directly to China, bypassing Western exchanges entirely. Russia's contribution came through strategic coordination and the weaponization of its own production. While Russia produces only approximately 5% of global silver output, the timing and destination of this supply carried enormous weight. Following the comprehensive sanctions imposed after 2022, Russia redirected virtually all of its precious metals exports towards China, India, and Middle Eastern partners, completely cutting off Western access. This wasn't simply about economics, it was strategic denial. Russian silver that once supplied European electronics manufacturers and American defense contractors now flowed exclusively to nations building alternative trade systems outside Western financial architecture. The message was clear: participate in sanctions, lose access to critical materials. The energy transition accelerated these dynamics beyond anyone's projections. Global commitments to renewable energy, electric vehicles, and grid modernization created exponential demand growth for silver precisely as supply chains fractured. Solar panel installations, which consumed approximately 100 million ounces of silver annually in 2020, surged toward estimates exceeding 300 million ounces by 2025. Electric vehicles, with each unit requiring approximately 1 kilogram of silver in various components, multiplied demand as production scaled from millions to tens of millions of units annually. 5G telecommunications infrastructure, requiring silver in every antenna and connection point, added hundreds of millions of ounces to annual demand. Water purification systems, medical devices, and advanced weapon systems each contributed additional pressure. The cumulative effect: industrial demand that was projected to grow modestly instead exploded, overwhelming a supply base that had been shrinking for years. Western governments and financial institutions initially dismissed the tightening silver markets as temporary disruptions, standard commodity cycle volatility that would self-correct through price signals bringing new supply online. This assessment proved catastrophically wrong.
Silver mining doesn't respond quickly to price signals because of the long lead times between discovery, permitting, construction, and production. Major silver projects require 7 to 12 years from initial discovery to first production, with costs frequently exceeding $500 million for significant deposits. Environmental regulations, community opposition, and technical challenges extend timelines further. Even if silver prices doubled overnight, new primary silver mines wouldn't produce meaningful output for a decade. The only quick response supply comes from secondary production, recycling of electronics, jewelry, and industrial scrap, but this source provides only 15 to 20% of annual supply and faces its own constraints around collection, processing capacity, and economic viability at various price points. The realization that this wasn't a temporary disruption but a structural transformation came slowly, then suddenly. By mid-2024, major industrial users began reporting inability to secure supply at any price. Defense contractors notified the Pentagon of potential production delays on critical weapon systems due to silver shortages. Solar manufacturers outside China face allocation systems that prioritize certain customers over others based not on payment, but on strategic relationships. Electronics companies redesign products to minimize silver content, accepting performance degradation rather than face supply interruptions. The paper markets continued functioning. Futures traded, ETFs reported holdings, derivatives cleared, but the connection to physical reality had become increasingly tenuous. Market participants began quietly questioning whether the reported holdings in ETFs actually existed in the claimed quantities, or whether custodians faced the same allocation challenges as everyone else.
The unraveling of confidence in paper silver markets marked a critical inflection point, the moment when financial engineering collided with physical scarcity and lost. Throughout 2024, a series of events exposed the fragility of a system built on leverage, fractional reserves, and the assumption that physical delivery would remain the exception rather than the rule. The first major crack appeared when a prominent silver exchange-traded fund faced redemption requests that exceeded its ability to source physical metal within contracted timeframes. The fund, which claimed to hold fully allocated silver in segregated vaults, initially delayed redemption citing logistical challenges, then offered cash settlements at prices significantly above the quoted spot price, a tacit admission that the metal either didn't exist or couldn't be accessed. This incident, though quickly contained through financial settlements and non-disclosure agreements, sent shockwaves through institutional markets. If a major ETF couldn't deliver metal it claimed to hold, what did that imply about the broader market structure? The implications extended far beyond investor confidence. They threatened the functioning of critical industries that depend on reliable silver supply. The semiconductor industry, already reeling from supply chain disruptions in other materials, found itself facing a new constraint. Silver's unique properties make it irreplaceable in certain applications. Its electrical conductivity exceeds all other metals, its thermal conductivity is unmatched, and its reflectivity is critical for specialized applications. While manufacturers had successfully substituted other materials for various components during previous shortages, silver's role in die attach pastes, bonding wires, and conductive inks couldn't be eliminated without fundamental redesigns requiring years of testing and certification. Defense applications faced even more rigid constraints. Military specifications often mandate specific materials with zero tolerance for substitution. Weapon systems, satellites, radar arrays, and communications equipment all contain silver in quantities that seem small individually, but aggregate to substantial volumes across production runs. The medical industry discovered its vulnerability when suppliers began allocating silver-based products. Silver's antimicrobial properties make it essential in wound dressings, catheters, surgical instruments, and water purification systems for hospitals. Medical-grade silver must meet stringent purity standards, and alternative suppliers couldn't simply be substituted without extensive regulatory approval processes. Hospitals and medical device manufacturers accustomed to just-in-time inventory systems suddenly faced the prospect of stockpiling critical supplies, a practice that seemed anachronistic in the modern era, but became necessary as supply reliability evaporated. The healthcare sector's experience illustrated a broader principle. Industries that had optimized for efficiency through lean supply chains and minimal inventory discovered that resilience required redundancy, and redundancy had been systematically eliminated in pursuit of cost savings. China's strategic positioning evolved from accumulation to leverage. By mid-2024, China's control over silver supply chains reached a point where the nation could effectively determine which countries and industries received adequate supply. This leverage manifested in various ways: preferential pricing for nations aligning with Chinese strategic interests, supply interruptions for countries supporting policies China opposed, and requirements that buyers accept payment in yuan or alternative currencies rather than dollars. The silver market became a testing ground for financial de-dollarization, a microcosm of the broader geopolitical struggle over monetary hegemony. Countries dependent on silver imports faced a choice: accept Chinese terms or face industrial disruption. For nations committed to renewable energy transitions, this created an impossible dilemma: achieve climate goals using Chinese-controlled supply chains or maintain strategic autonomy while delaying decarbonization.
Russia's parallel strategy focused on creating alternative trading mechanisms that excluded Western financial institutions. Russian silver transactions increasingly settled through bilateral agreements denominated in rubles, yuan, or commodity-backed instruments rather than dollars. These arrangements bypassed SWIFT, avoided Western banks, and rendered traditional sanctions mechanisms ineffective. More significantly, Russia began linking silver supply to broader strategic commodities, offering discounted silver to nations purchasing Russian oil, gas, or military equipment. This bundling strategy created packages of strategic resources that reinforce non-Western trade networks while further isolating Western economies from critical supply chains. The effectiveness of this approach became evident as nations previously aligned with Western sanctions began quietly pursuing bilateral agreements that secured resource access at the cost of geopolitical alignment. The financial markets' response revealed deep institutional denial about the severity of the situation. Rather than acknowledging fundamental supply constraints, many analysts attributed price volatility to speculation, market manipulation, or temporary disruptions. Major investment banks published research dismissing concerns about physical shortages, pointing to continued trading volumes in paper markets as evidence that supply remained adequate. This analysis missed the essential point. Paper markets can function smoothly even when physical markets are broken, precisely because most participants never demand delivery. The system worked until it didn't, and when confidence collapsed, the transition would be instantaneous and catastrophic. A few prescient analysts recognized the pattern. It resembled the period before the 1980 silver manipulation crisis, the 2008 financial crisis, or the 2021 nickel market implosion. Markets operating normally on the surface, while structural fractures deepened beneath. Individual investors and smaller institutions began acting on information that mainstream institutions ignored or dismissed. Physical silver premiums, the markup over spot price for actual coins and bars, reached levels unseen since the 2011 silver spike. In some markets, premiums exceeded 50%, meaning a buyer paid $15 per ounce over a $20 spot price to obtain physical metal. Delivery time stretched from weeks to months, with some dealers simply refusing new orders until existing backlogs cleared. This divergence between paper spot prices and physical acquisition costs represented the market screaming that something fundamental had broken, yet futures markets continued pricing silver as if supply and demand remained balanced. The disconnect created opportunities for sophisticated arbitrage, but also signaled approaching crisis. When financial prices and physical reality diverge substantially, resolution typically comes through violent price movements that force convergence. Central banks, traditionally focused on gold rather than silver, began quietly reassessing their positions. While official statements remained centered on gold reserves and monetary policy, several central banks initiated programs to acquire physical silver, recognizing its dual role as monetary metal and strategic industrial resource. These programs remained largely unpublicized. Central banks avoided market-moving announcements that might trigger front-running or panic buying. But the shift was evident in flow patterns. Silver that once circulated freely through commercial channels increasingly disappeared into institutional vaults with no intention of re-entering markets. This represented a fundamental transformation, silver transitioning from a commodity to a strategic reserve asset, similar to oil stockpiles or rare earth element reserves. When central banks compete with industry for physical supply, prices must rise to equilibrate demand with production capacity, or shortages emerge that disrupt economic activity.
The end game of the silver market disruption isn't a single catastrophic event, but rather a series of cascading adjustments that will reshape industries, redefine geopolitical relationships, and force a fundamental recalibration of how the world values and allocates critical resources. What comes next isn't speculation, it's the logical conclusion of forces already in motion, trajectories that can be measured, quantified, and projected with uncomfortable clarity. The question isn't whether transformation will occur, but rather how quickly it unfolds and which nations, industries, and institutions adapt successfully versus those that cling to outdated assumptions until reality forces painful corrections. The immediate consequence manifests through price discovery, a process that will be far more disruptive than markets anticipate. Current silver prices, hovering in ranges that reflect financial market expectations rather than physical scarcity, must eventually reconcile with underlying supply-demand fundamentals. Historical precedents suggest this reconciliation doesn't occur gradually through smooth adjustments, but rather through sharp, discontinuous repricing events that catch most participants unprepared. When similar dynamics played out in palladium markets between 2000 and 2001, prices quadrupled within 18 months as industrial users competed for insufficient supply. When rhodium faced supply constraints in 2008 and again in 2021, prices increased tenfold in compressed timeframes. Silver's market structure, larger than these niche metals but smaller than gold or oil, suggests repricing could be even more volatile. A move from $25 per ounce to $75 or $100 isn't hyperbole, it's mathematical necessity if physical shortages persist and industrial demand continues growing. Such a repricing would devastate industries operating on thin margins while creating windfall profits for producers and holders of physical metal. Industrial adaptation will follow three distinct pathways, each with profound implications. First, substitution. Industries will frantically search for alternatives to silver in applications where technical compromises are acceptable. This process has already begun in solar manufacturing, where researchers experiment with copper alternatives for electrical contacts, accepting slight efficiency reductions to escape silver dependency. Electronics manufacturers redesign circuit boards to minimize silver content, using alternative materials for non-critical connections while preserving silver only where absolutely necessary. These substitutions reduce total silver demand but cannot eliminate it. Certain applications have no viable alternatives without fundamental technological breakthroughs that require years or decades to develop and commercialize. Second, efficiency improvements. Manufacturers will extract more value from less silver through advanced manufacturing techniques, recycling innovations, and process optimizations. Solar manufacturers have already reduced silver content per panel by 60% over the past decade. Further reductions will continue but face diminishing returns as technical limits approach. Third, demand destruction. Some applications will simply become economically unviable at higher silver prices, leading to project cancellations, product discontinuations, or market exits. This represents the harshest adjustment mechanism, eliminating marginal uses through price rationing. The geopolitical ramifications extend far beyond commodity markets into the structure of international relations and alliance systems. Nations dependent on Chinese-controlled silver supply face a stark reality. Strategic autonomy requires either securing alternative sources or reducing dependency through technological innovation. This drives several responses simultaneously. Western nations will prioritize domestic mining development, accepting higher environmental impacts and production costs to ensure supply security. National security concerns override economic efficiency when critical materials are involved. Friendshoring initiatives will accelerate, with Western allies coordinating to develop non-Chinese supply chains even at premium costs. Countries like Mexico, Peru, Australia, and Canada will face intense pressure to increase production and align supply with Western strategic interests, while simultaneously receiving competing offers from China for partnership and investment. These competing influences will test alliance structures and force nations to choose sides in a fragmenting global system. The financial system faces its own reckoning as the fiction of infinite paper claims collides with finite physical reality. Silver ETFs, derivatives markets, and futures exchanges must either reform their structures to ensure genuine physical backing or face collapse when confidence evaporates. Several pathways exist for this reformation, requiring full physical backing for all paper claims, which would dramatically reduce leverage but ensure deliverability, implementing two-tier pricing systems that distinguish between physically deliverable contracts and cash-settled instruments, explicitly acknowledging the difference, or transitioning to blockchain-based systems that tokenize actual physical silver with transparent auditing, eliminating fractional reserve practices. Each approach carries costs and benefits, but maintaining the current system, where paper claims exceed physical supply by orders of magnitude, is untenable once participants lose faith. The transition will be messy, involving litigation, bankruptcies, and regulatory interventions as the pretense of equivalence between paper and physical silver collapses. Investment implications ripple across asset classes in ways that extend far beyond simply buying silver. Mining companies with significant primary silver production will experience dramatic revaluations as their reserves, currently valued using depressed silver prices, are reappraised using fundamentally higher price assumptions. Companies with silver as a byproduct of base metal mining gain unexpected windfalls that improve project economics and enable expansion. Junior exploration companies with silver discoveries gain access to capital as investors recognize that new supply sources command strategic premiums. Conversely, industries heavily dependent on silver inputs face margin compression, competitive disadvantages, and potential insolvency if they cannot pass cost to customers. Portfolios constructed without consideration of silver exposure through industrial holdings face unexpected volatility as this hidden factor suddenly matters. The traditional 60/40 stock bond portfolio, already struggling in an era of synchronized equity and bond market declines, gains nothing from conventional diversification when commodity constraints disrupt both corporate earnings and economic growth. The renewable energy transition, ironically one of the primary demand drivers for silver, faces an existential challenge that policymakers have largely ignored. Current climate commitments assume abundant availability of critical materials at modest costs, allowing rapid scaling of solar, wind, and electric vehicle production. This assumption has proven catastrophically wrong for silver, and increasingly appears dubious for lithium, cobalt, rare earth elements, and other enabling materials. The energy transition cannot proceed as planned without either securing adequate material supplies at higher costs, fundamentally redesigning technologies to eliminate bottlenecks, or accepting slower transition timelines that delay climate goals. This creates painful trade-offs: achieve decarbonization targets by accepting Chinese supply chain dominance and the geopolitical leverage that accompanies it, or maintain strategic autonomy while delaying climate action and accepting greater warming. There are no easy answers, only choices between imperfect alternatives that carry different risks and costs. What comes next, ultimately, is a world where physical resources matter more than financial engineering, where supply chains are valued for resilience rather than efficiency, and where strategic positioning in critical materials provides geopolitical leverage that rivals military or financial power. China and Russia didn't break the silver market through superior technology or innovation. They broke it through patient accumulation, strategic coordination, and ruthless exploitation of Western complacency. The lesson extends beyond silver to every critical material that underpins modern industrial civilization: rare earths, lithium, cobalt, graphite, manganese, and dozens of others where concentration of supply creates vulnerabilities.
The age of cheap, abundant commodities supported by globalized supply chains and financial market assumptions of infinite substitutability is ending. What replaces it will be determined by which nations, companies, and individuals recognize this reality first and position themselves accordingly. Those who adapt will prosper. Those who deny will pay catastrophic costs for their illusions. The silver market is simply the first domino. Many more will fall in sequence, each disruption more severe than the last, until a new equilibrium emerges from the ruins of outdated assumptions.